Now, going forward, now we have this trade here. I'll first talk about how to manage this trade. You can, down here, when you see your positions, so you see the instrument, so where you've opened the trade. You also see the quantity in terms of Ethereum. You see the value of the trade. You see your entry price. You see the market price. You see the liquidation price in case you've entered with wrong risk and money management. And then you see your internal margin. And then you also see your just general margin details, which I guess you don't need to care about at this point. And then you see your unrealized profit and loss, whether it's a plus or a minus. And then you can actually click reverse the trade. In case if you wanted to reverse the trade into a short, you can click reverse the trade and simply reverse it. Or you can close it by a market order. Or right from here, you can actually add your stop loss or take profit. So let's say if Ethereum drops to, let's say, $3,620, it will be a loss of $50, but this would be your maximum loss. I always suggest you use stop losses because otherwise it can be extremely dangerous. And you can place a take profit, let's say $3,700. Which is bad risk management. Also, a little bit of tip on risk management. If you're risking $50, you should always at least target to take 3 to 1. So in this instance, should be $150. So you click confirm, and this will be adding your take profit and your stop loss right on a chart. So there's going to be your take profit right here as you set it up. And then so it's going to be automatic. So you can set it up and just go to sleep and just forget about it. So you'll have your maximum risk right here and then your take profit right where you've set it up. And then certainly you can remove those orders right on a chart or you can move them right on a chart as well, up and down as you wish. And it also shows you what is the value of your stop loss right here on the screen. So when you are ready to close your trade, let's say you just click close by a market order, or you can use this window right here to close your trade. And then your order history and your trade history, everything is going to be saved right down here. So you'll be able to see that. And then on the chart, you will be able to also see your trades as well marked in the chart. Now, when it comes to the trading strategy itself, you certainly can use the order quantity of Ethereum. You can also use USD quantity and also margin. Me personally, it's a lot easier to just trade with USD value. Now, when it comes to the trading strategy itself, because so far you understand how to buy long. So this is when you're buying an asset, and how to short. So shorting is all the same, it's just instead of buy, you click sell or short. So in this instance with short, you're making money from the price going down. With long, you make money from the price going up. Now, in terms of your leverage, which you can adjust right here, so going back a little bit to this, and when it comes to margin, I usually use cross. You can down the road, soon the isolated here will also be available. For now, the cross is, so that means that your entire account, you can use down the road isolated, so only the money that is in your, it still is basically, to be honest, the same thing. If you use proper risk and money management, when you don't do anything stupid, it doesn't really matter much if it's cross and you use stop losses, if it's cross or isolated. You don't need to worry about this too much, as long as you use proper risk and money management and use stop losses, something we can discuss today as well. Now, when it comes to leverage, so there is 1x, there is 5x, and then there is really custom. You can set up the leverage as you would like. Now, when it comes to what it means, so let's say in your account, well, I have $10 less now, should have taken a short trade. Anyway, so $5,000, if you use 1x leverage, you will be able to open a position only that is going to be worth 5,000. If you're going to use a 10x leverage, you're going to be able to open a position that is 10 times more than what you have in your account. So that means that if the asset goes up by 10%, you can double your account. But if it goes down by 10%, you can actually lose your entire account. So mind your leverage. And then there is something like 50x, something that is pretty crazy. With just $5,000 in your account, you can open a $250,000 position. So basically you're putting up front your own $5,000, but the exchange gives you and lets you borrow almost like $238,000 in this particular instance, which is pretty crazy. You can make 3x of your deposit in 2 hours, or you might lose everything in 5 minutes. So that's just how it works, and leverage is there for you to really scale your bank. But for me, I just usually use 10x leverage, 5x leverage, and that's about it. So what I care about the most is the amount of risk that I take per trade. And here I will give you some rules on risk management. First of all, I never risk more than 1% per trade of my deposit. If I'm really sure in a trade, I might do 2-3%, but normally the rule of thumb is 1%. So if I have $5,000 in my trading deposit, I will probably risk a maximum of $50. So that I can be 100 times wrong in a row, and which is impossible, and then I could only lose everything. Certainly, I would never risk 10%, 20%, or 50% unless you're just gambling and you're just trying to turn your 5K into 20K in 3 days. And there are people who have done it. Well, I don't recommend it. It's really up to you. I've never used anything above 1% on average. Some of my bigger trading deposits, I've been using 0.1, 0.5%. Yes, it takes a lot more time, but it's a bit more consistent. Now, the next rule when it comes to risk management is the 3 losses rule. For me, especially if you're trading actively, and let's say you've lost 3 trades in a row, on that particular day, I would normally stop trading and reevaluate. Then there is another rule, which is 3-to-1 rule, and I've also already spoke about it. If you're taking a trade, let's say you've taken, just a brief example, you've taken your long from here. Your stop loss could be below this low area right here, and your take profit should be at least 3 times higher. So the distance from your entry point to your stop loss should be 3 times smaller than the distance from your entry point to your take profit. This is very important because if you're gonna be, some people are risking $100 to make $50, and sometimes they can have a big success rate, but then just 1, 2, 3 losing trades, they wipe out their entire profit. So 2-to-1, 3-to-1, 4-to-1. Some of my trades I run like 10-to-1. So this is something that I really suggest you do as well. And another rule that really will help you quite a lot, and we're going to talk about analysis, what kind of analysis you can do. To give you a brief example, let's say you've taken a trade from right here. So this has been your entry point. Your stop loss, for example, hypothetically, has been right here. And your take profit, let's say you're doing something like 3-to-1, is somewhere in this vicinity. Once the price has moved at least one size of your stop loss in your profit, just take your stop loss and move it into break even. So in this case, if the price right from here just reverses and goes down, you will have a risk-free trade. So that's what you can play around with this. You can have different rules. You can have, for example, 2 stop loss sizes into your profit, or maybe as soon as the price moves at least a little bit, you don't risk it. You put your stop loss into profit or to no loss, and you just don't risk it, and you actually get yourself a nice entry for absolutely free and risk-free. Certainly, there are going to be times when the price comes that really stops you out like a son of a bitch and then moves into your take profit area. This is the world of trading, so it's fine. You just find your best strategy and what works best for you. Now, a little bit about the analysis and how you can actually find your entry points and exit points. And for this, I have quite a few interesting things for you guys. So first of all, I want to point out exactly how candlesticks work. So for this, let's really zoom in so you actually understand what candlesticks are and how they work and what is the point of candlesticks. So how to read them properly in case you really don't know, because it is very useful for you to understand and to know this. Let's take, for example, this beautiful, let's actually zoom in even more so that it actually is a lot easier for you guys to see. So here is a beautiful candle right here. So the candle consists of just really a couple of things. It has, if it's a green candle, it has open. So this is where the price opens, because this candle moves up and then this candle opens. And normally this is going to be the point, so the bottom body of it. So this, like this colorful part, is the candlestick's body. Then we have the wicks. The wicks are these tails. Let me move this out of the way. These tails at the top and at the bottom. Some of the candles like this one don't have wicks. It's fine. It means the following. So we have the open. So this is going to be our candlestick open. This is going to be our candle close. Since this is a 5-minute chart, as you might remember, it takes the candle 5 minutes to actually form. So it takes 5 minutes for it to open, to play around, to go somewhere, and then to close, and then the next candle opens up. So, and the wicks themselves, so these tails right here and at the bottom of the candle, are where the price has gone to, but did not close at that price point. So these are going to be like the empty moves, as they call them sometimes. So once again, candle open, candle close, the upper wick, the lower wick, candle body, and then the last part we have the candle high and the candle low. And actually, when you put your cursor on the candle, actually right up here, you will see all the details. So you will have the O, which stands for open, H for high, L for low, and C for close. So all the precise price points, you don't need to measure it like this, where is the price point. And that's from this is how the candles really form. So you have candles, then you're gonna have patterns. So you will have separate candles, then you will have waves. Bottom wave, top wave, bottom wave, top wave. And as you keep zooming out, then down the road, these things will start turning into trends. So let's say it's a micro because it's a 5-minute chart, but we have candles, then we have waves, and then we have, for example, bottom wave, and let's say top wave. But all of this put together is a micro trend. So, and these micro trends actually form what they're called more macro trends. So in a macro trend, let's say we've just talked about this tiny small move. If we zoom out, and let's say we go to 1 hour chart, so like it's a lens type of thing, lens concept, this could arguably, because here you're gonna see all the same aspects, so you have top wave, bottom wave, and then there is smaller ones as well, top waves and bottom waves. The bigger one, bottom wave and top wave. So it's like you can find a million of them and you can interpret them in very different ways. But overall, as you keep zooming out, you will see that every single pattern, every single candle really belongs to a price movement. So here, arguably, we've seen a small uptrend, and it theoretically could be a continuation of, for example, we had an uptrend here where the price was really pushing higher. Then this uptrend kind of got broken because we have this level, and then as we actually broke down below, we retested this level, consolidated, and lost power. So this is also on the topic of trends a little bit. So uptrend, basically a break of structure, downtrend. Same thing was basically here. I think that the real break of structure was initially here. That we've created, there is higher high than the previous one. There is a higher low, lower high. And this kind of, and then as we were breaking this low right here and created another low, we kind of created a micro downtrend inside of this massive uptrend. So this is just how the price forms, so you guys understand a bit more. And then we had this bigger breakage of this trend, and possibly we've created another lower high than this one, and possibly if we go down from here and create something like this, this will be a confirmation that our trend overall, even if we just zoom out, could actually continue downwards. And this is how sometimes, this is very basic technical analysis, how you can actually predict price movements. It's not always accurate, it's very basic, but it's very beginner friendly. So you start understanding the thing which is called price action. So you start understanding how exactly it works overall. Because even right here, we've had an ongoing lengthy down move with lows and highs, lows, highs, lows, and they were lower, lower, lower. And then we had this low, and then basically this low right here didn't go below this low, and right here we had a confirmation of an up move. Simply because we broke above, we kind of stopped this down move trajectory, and we moved up. And the confirmation was right here at the break of this high. So it's very basic technical analysis, something that helps you really read the chart, understand how the chart works, and then there are different patterns, like head and shoulders pattern, there is double top pattern, and really a lot of different stuff. And then you will see the same, for example, in weekly chart. A double top formation, a head and shoulders pattern is here is a shoulder, arguably, here is a head, here is another shoulder, and then what people often will do, they will find a neckline of this whole formation, and the break of this neckline is going to be the short trade. So they would be, according to the formation, taking a short trade from the break of this so-called neckline. And their target for this trade will basically be the high, the length of this actual head. So this basically would put the target at like far too low, so it was not really that realistic. But anyway, Ethereum went from 2,500 down to 900, so I think it was good enough. But these are very basic formations. Sometimes they play out, sometimes really not, but this is just generally what you can use to really understand price action and how it all forms. And as you go into smaller time frames, you will start seeing a lot more coincidences, and you will see that the patterns actually repeat themselves, and sometimes you can look at them to really simply kind of understand where the price might be going next from the general perspective. Now let's discuss what in my opinion is a better way to analyze the market. Now you understand what the candles are, you understand what different trajectories the market could be going in. Now let's understand how to find a precise entry point. Now let's switch things up. Let's actually go to, for example, Bitcoin. And let's find some interesting levels in, let's say, Bitcoin. And then we're going to talk about indicators a little bit, about Fibonacci and RSI, etc.